Welcome back to another episode of On the Brink with Castle Island Ventures. Today, we have a great episode with Nick Grossman, a partner at Union Square Ventures. Union Square has been at the forefront of the crypto asset industry for a long time. It's invested in a number of leading companies, including Coinbase at the Series A, Protocol Labs in 2016, Algorand in 2018, and a lot more. The firm has also been a pioneer in terms of investing in some of the more liquid fund structures, including Polychain, Metastable, BlockTower, Multicoin, Autonomous Partners, and Placeholder. So Nick spends a lot of time at USV on their crypto efforts, including leading the firm's Series C investment in Helium and working closely with the firm's participation in the Libra consortium. So this was one of my favorite episodes to date on the podcast. Nick is an original thinker. He comes at the industry also with a refreshingly humble take. So we spent a good amount of time talking about the various theses in this industry, how you might think about the theory of value accrual in a tokenized network, and generally where Nick sees opportunities in terms of investment categories and what he's most excited about going forward. So I think you'll enjoy this one. So without further ado, here's our conversation with Nick Grossman of Union Square Ventures.
Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
The federal government loans American International Group, AIG, $85 billion.
This is a different kind of market, and the Fed is asleep.
The federal government is stepping in to stabilize Fannie Mae and Freddie Mac, the two mortgage giants that have been threatened by the housing crisis.
The Bank of England has pumped £75 billion more into Britain's ailing economy with a new round of quantitative easing.
You print a couple $1 trillion and all of a sudden people start to worry. So out of this worry, we have something called the Bitcoin.
Welcome to the On the Brink podcast. We are very pleased to have Nick Grossman, partner at Union Square Ventures, joining the pod. Thanks for joining us, Nick.
Howdy, happy to be here.
Right before we started recording, we started talking about how we got into the industry, how we started to pay attention to this. And part of my origin story was reading Fred Wilson's blogs, your partner, Fred Wilson. So tell us a little bit about how you got into Union Square Ventures, what your path to this industry was.
Sure. My path's pretty sideways and crooked and twisty, but I think in hindsight, you can always draw a straight line through things. Going way back, I was always a geek and somebody who liked to hack and build stuff and make stuff. And then when I went to college, I grew up in New York City. I ended up going to college in California. I got kind of weirded out by living in the suburbs, and I promise I'll get there eventually. But California strip mall suburbs were I felt all dislocated and strange. And I got interested in city planning and what is it that makes cities feel the way that they feel? Having gone into college thinking I'm going to be an engineer, I left college thinking I'm going to be an urban planner. Why do cities become the way they become? And I went and worked in that field for a while, I realized that once you focus on the thing that you like, the outcome, what do places feel like, you start digging underneath and focusing on, well, how do they become that way? What are the rules that make it so? What are the processes? What's the governance? What's the structure? And so I went from sort of design side to policy and process side. And it was the same story for me on tech. I've always liked products and apps and the user experience side of things. And on the tech side of my career, I went from being a builder of stuff to thinking about, well, why is this ecosystem vibrant? Why does this product feel good? What are the underlying forces that make it so, whether that's the open web or the policies of the App Store or whatever. And sort of fast forward, my interest in cities and city infrastructure and tech infrastructure collided. For 7 years before working at USV, I ran an incubator in New York called Open Plans that was focused on startups around open data and cities. And that was okay, how do we make cities more accessible and vibrant and good from an angle of tech architecture? And so we helped New York City build a real-time bus API in an open layered format using open standards. We helped the city of Portland redo their whole mapping infrastructure also based on open standards and open source. And so I kind of got into this mindset of open systems are the most interesting, and what is it that makes them tick, and what are the forces behind open source and open data. And I ended up coming into USV 7 years ago now, focused on sort of some tech policy issues that were affecting startups, things like net neutrality and copyright and so on. This was all pre-crypto. And then as USV over the years got more interested in blockchains and crypto and the kind of intersection of commercial web with open source and open standards that was like a natural thing that I got interested in and zeroed in on from the beginning, back when we started looking at it around maybe 2012 or so.
That's fascinating. I mean, there must be a lot of similarities between city planning and crypto asset networks, in the sense that a city is trying to get people to come and work in the city and build things. Crypto asset networks go through the same type of issue, trying to get developers to come and make the economy grow.
Yeah, and there's also the tension between shopping malls and great neighborhoods, and sort of controlled corporate places and experiences, and messy, chaotic, organic experiences. And then what are the right incentives? There's a whole money piece that really has nothing to do with cities per se, but is parcel of making cities interesting. But then there's also governance and participation and all that stuff, which is a real pain in the ass and real difficult to engage with. But you don't get good systems without having that stuff. And I think it's the same with the internet. And like today's internet is this transition from shopping malls, the commercial web, to open cities, if you will, on crypto networks, and transitioning from a top-down corporate dictatorial type of governance model to more of an open governance model. So all that stuff is in the works right now, and we're just figuring out what to make of all of it. But it does seem like one sort of whole bag of things to me.
Definitely. So Union Square has been at the forefront of this technology for a very long time. I mean, I remember reading Fred's blogs back in probably 2010 or 11, talking about Bitcoin, talking about eventually Coinbase. So talk a little bit about what the firm has done in the crypto assets, public blockchain space, and more broadly, maybe how you think about a thesis for the category.
Sure. So everybody comes at crypto from a different angle. I think it was you, Nick, who talked about the tribes. Am I right that you wrote the piece on the tribes? Money crypto, tech crypto.
I think that was actually Arjun.
Oh, was it really?
Yeah.
We have it in one of our decks.
I like that.
I think it's a really good framing.
I think it's great. Yeah, we're probably on the money side.
You wrote about the narratives of Bitcoin and how those evolved. And I thought that was very helpful too. And all this is to say is that it's hard to put one definition on crypto, because even just within Bitcoin, the narrative has changed like 5 times over the course of 10 years. And then also there's this idea of tribes and people coming at it from different lenses. So I think it's safe to say that USV came to crypto through the tech crypto lens. And everybody has their sort of driving motivation of why they think this is so important. I would say at least the origin sentiment for USV is about closed platforms and competition on the web. And so as investors in startups, we look at, well, what does it take to launch a new company? In the old days, it was write some code and publish it and you have a website. Before that, it was maybe cut a deal with AT&T. That seemed problematic. And then in the mobile era, it became try to get onto the App Store or try to compete with Google, try to compete with Facebook, launch on Facebook's platform and then get crushed by them. And so I think we were really feeling the pressure in the early 2010s of, man, the big dominant tech platforms have a lot of power. It's making it harder every day to launch a startup. And back in the day when the web was more the open web, not the commercial web, it was different. And it felt, when we looked at Bitcoin, we were like, oh, this feels like a next generation of web protocols. Web protocols are open. Open makes it easier for people to innovate and create startups. And like, we're feeling boxed in. And that's what got us excited about crypto. It's not the only thing that got us excited about crypto, but that was sort of, has always been the thing in the pit of our bellies that lit the fire, at least.
In the case of Bitcoin in particular, do you think that there's a bit of a tension there as it started as a super open peer-to-peer layer, and increasingly we see reintermediation on the platform with 20% or so of all the Bitcoins are sitting in custodians, and we have all these additional financial layers that are being built which mediate the way they'll intermediate the end user's contact with Bitcoin itself. Is that a corruption of the original value, or is it just an inevitability that it has to go through?
At the beginning phase, it's probably more of an inevitability, and there's a question of how far will that power go. So if you were to draw the parallel from the open web to the commercial web, SMTP is an open protocol, but most people use Gmail. Gmail then becomes a powerful system on top of an open platform. Bitcoin is open, and custodians or exchanges or big wallets in the future are going to be centralized and have a lot of power. And then the question is, on the one hand, it's necessary because we need to bring people onto these platforms. And most people don't want to run their own email server, don't want to custody their own crypto. And it's a good opportunity for businesses to fix that and smooth the on and off ramps. And we've invested in that thesis for sure. I think we would argue that in today's web, Amazon, Google, Facebook, Apple have too much power, and you need to look at ways to limit their power. And then looking at layers on top of the crypto fabric, question is, where will they accrue power? What will really be driving it? And what will be the smartest ways to think about maybe limiting it in the future? Things like wallets, browsers, phones, which of those are going to be services and which of them won't be. I really feel mixed about it. And I think we've been debating this internally for years and thinking about how to invest in this space. And I do think that the on-ramps are important, especially in the early days. Yeah.
One of the things that you guys have really pioneered is, as a venture fund, you've invested in a number of crypto hedge funds as those were emerging. So what did you see there, and what was the driving force to move into those type of investments?
Sure. I think there were a few motivations there. One of them was really boring, but just more administrative than anything. As you guys know, operating in a venture fund model, you're limited to the types of assets you can hold and still fall and not be a registered fund with the SEC. And so that's 20% of your overall assets. We didn't want to go that route and register. And so we could never have an active trading operation, at least in our current structure, without changing something. So that was one piece. Being LPs and other funds gave us the ability to do that. Second one is just exposure to a broader set of assets. I think we believed that there's something, and we still believe there's a big thing going on here, more than we can tap into ourselves. And it feels a little different than just sort of traditional stocks in terms of being a new thing. And then the third thing is, relationships with GPs. I think the folks that we've backed starting up crypto funds are really smart and really deep in the space. And as much as we believe in this sector, I think we'll always be generalist internet investors and tech investors, and not way, way, way deep in all the stuff the way that you guys are, the way that a lot of the managers that we've backed are. And so I think it's been a great education for us. I think our point of view has been that we see all this stuff, but we can't claim to know everything about this. And there's a real new skill set here. And if we look at some of the best venture or some of the best investors in the space, it's a really odd mix of skills. I mean, there's a venture component, there's a public markets component, there's a community and governance component. There's like a lot of things you need to do to be effective as an investor in the crypto space that are just very, very different than being a traditional VC. And so I think we've benefited from having all those relationships.
That makes sense.
So a lot of the funds are kind of strongly thesis driven. It depends on your view whether that's a help or a hindrance. Sometimes being super thesis driven can mean that you become ideologically pigeonholed. And I guess the role of a venture investor is to be as open-minded as possible. But certainly we have a certain thesis on value accrual within crypto. Do you have a taxonomy that you employ, or a view on what you think the big winners might be, categorically speaking, in this industry, or do you just try and stay as open-minded as possible?
We've always found, generally speaking, trying to have a thesis helps. Obviously, there's a risk of becoming pigeonholed, but it has always been more of a benefit to us to try and have an articulated thesis, because it just helps you say no to a lot of things. And I think you guys have done a good job of understanding what your thesis is and what that means you're going to ignore. So we try to do that within every category, whether it's healthcare or education or fintech or crypto. We spend a fair bit of time trying to understand what is the angle that we have here. What are the things that we're looking for to help us say no to a lot of stuff. In the case of crypto, the way to think about our strategy has been, we've been looking for on and off ramps that are going to bring access to lots and lots of people. So that was the thesis behind Coinbase. Before we knew anything that was going to happen here, if this is going to get big, people are going to need to get attached to it. As far as thinking today at like the landscape of different kinds of assets and different types of investments, we still believe that the access piece is really important. There's another one of those that's developer tools, and that just feels like a really big category that hasn't been built out yet. And if both on the finance, sort of the money side and the tech side, that needs to emerge. In terms of assets themselves, we're not investing in lots and lots of things. We have a relatively small number of more concentrated positions. We've been trying to spread that across sort of tent poles in different areas of the space that we think are going to be important and interesting. So part of that is sort of money and on the finance sort of side of things, or money really is the better way to put it. Another one is gaming. We're invested in the company behind CryptoKitties, Dapper. We've also invested in a few functional networks like the Filecoin network, like the Helium network, where trying to use a crypto asset to coordinate an infrastructure I think those are sort of remain to be seen, like how those play out. And so we've been trying to sort of find one or two things in each of those key areas. Identity is another one. Who knows exactly how we'll get to identity, but I think self-sovereign identity or sort of user-controlled identity, where individuals have more control over their data, their encryption, their money, that has always felt like a real driving force to us. So we've tried to basically create a balance of different sort of infrastructure roles, money, and then on and off ramps.
You guys, and you personally have written a lot about this, about how giving users ownership in a certain system like Filecoin, for instance, although that one's still more of a hypothetical than it not being launched, but how giving a user ownership piece of a system is a real kind of incentive aligning force. The nodes in the network, or the individuals as nodes, they get rewarded for adding value to the network by virtue of their participation. So it's this really virtuous feedback loop. Then there's also the critical angle on that, which is some individuals may want to buy tokens for consumptive purposes to use the network resources, but they might be getting crowded out by the folks that are investing because they presume that the network value is going to go up. And so the speculative element makes it more difficult or tricky to access the network resources. So you have the kind of two functions which are conjoined within one model, which is buying the token to get the network resources and then buying the token as a bet on the future of the network. Potentially a conflict there. So do you think that that can be kind of squared away, that eventually these things will just reach maturity and the speculative element will become less intense and that's how the tension is resolved? Or what's your view on that?
Yeah, I mean, I think certainly consumers prefer to pay for things with assets that are stable. I think that's pretty well understood. And at the same time, part of the whole point of these networks is that, especially at the early stages, if you're an early participant and an early believer, you can benefit from the growth. And so I think my favorite answer, I don't know if it's the right answer, is that over time things stabilize and you get to a more stable price where a single asset could be more sort of a transactable asset, but it still had the benefit of accruing to the early believers. Bitcoin's sort of the classic example here, where you want to use Bitcoin to buy potato chips, but you also want to hold it because it's, going up, and the jury's still out even on something as old as Bitcoin.
I think this is one of the things that you talk about thesis. We generally have a hard time imagining a world where, in a category specific view, tokens would be treated like money. And so I think John Pfeffer wrote the canonical kind of velocity argument here, which is essentially that people will like to hoard their wealth in things like dollars or potentially Bitcoin or potentially another crypto asset that ends up being treated like money. But if you only need to provision the asset to do a finite resource for a minute or two, wouldn't you just hold, to your point, stable value and then transact into that token? And so if that plays out, which I don't know if that will hold or not, would lead us to believe that a lot of these things could work, but just not hold value at the protocol layer, or not hold significant value at the protocol layer. Are we thinking about that the right way?
I guess we just don't know yet.
Probably the best answer. These are all just big experiments at the end of the day.
Yeah. I think it's also hard to talk about things as money or as stock or as property. We have these buckets in our head of things that are all really different, but in here they're all kind of blended. And so I think there's a question, would you pay for AWS, you were saying earlier, with Amazon stock? Like, that seems kind of crazy. We have a portfolio company called Stash, which is not crypto related at all, but it's like a consumer investing product. They just launched this product, I forget what it's called actually, but basically a stock back, where they watch your spending and then they give you rewards in stock of the companies that you spend a lot at. So if I buy a lot of Starbucks, I can earn my points back in Starbucks stock. And just like, that's kind of cool because it's like, okay, I'm part of this system, therefore I want to have more participation and exposure in it. And so I really don't want to give up on the idea that we can build certain kinds of open systems where the participants capture value from them. And then the question, though, is what does that mean for transactability or for something to be like money? And I think we're seeing some really good experiments in like dual or multi-token systems like Maker or Helium, which is another one where investors in has a multi-token system to sort of partially solve for this. So I honestly am not smart enough to really theorize on that, but I do think we'll see something. We'll start to learn some stuff in the next couple of years.
Yeah, the multi-token model is so interesting, actually, because it disaggregates the functions, the investment token and then the transactional token. So Maker is a great example. There's also Sia Fund, Sia Coin, based here in Boston. I think that was quite pioneering in that they started it in 2014 or 2015. Recently got a slap on the wrist from the SEC. But I think we'll probably see more of those, actually, as it becomes clear that maybe some of these tokens that are oriented with really explicit language in terms of dividends or capital return probably resemble securities under the current framework. What I find very interesting, because we're talking about an instrument which represents some cash flow driving from something or other. Maybe it's an exchange like Binance Coin or Bitfinex's token, or maybe it's like the usage of network resources like in Sia. I guess the challenge is what happens when that gets forcibly remanded to the walled garden of securities in the US. How do you get the same benefits from
I worry
the
about
system?
that. Yeah, I really do. And I think this question of the regulatory buckets and the restrictions that puts on this stuff will have a lot of implications, because running a Bitcoin node is not the same thing as manufacturing securities, and I don't need a broker-dealer license to do that. And the beauty of all of this is that it's just code that you just run and it just works. And I can't remember if you asked this now or previously, but the community benefiting from the growth of a network is one sort of potentially awesome thing of this whole architecture. Another one is interoperability and sort of things just working automatically. So crypto assets are bearer assets. Like, you show up with it, it works. You don't need to swipe a credit card or sign a contract or go to get a Schwab account. And so those two things are different, but they're, I think, in my mind, equally important, particularly the bearer asset part. And the more that these things get into the securities bucket, the more you're taking out the it just works element. And I think the it just works element is one of the things I'm most excited about how this is going to change things for consumers and just regular people. I think we have the potential to make tech systems that are just much more frictionless and much more beautiful and less hassle, and we won't have to remember passwords as much. And there's just all this stuff that can work if the things can just automatically work together. If you get into securities land, like formal securities land, a lot of that starts to break.
Because they turn into IOUs at that point. They're not strictly bearer assets.
Exactly. Or you have to go through intermediaries to use them. To your earlier question, it wasn't really your question about intermediaries, but I think it's an important question.
Yeah, I mean, imagine if every Filecoin transaction was a securities transaction. I'm not sure the network would have any utility at that point. You must deal with this quite a lot with portfolio companies and companies you're looking at from the regulatory perspective. Do you think we're any closer to getting clarity on, are some of these things securities? I mean, if you had a wish list, I guess, what would you hope for here?
I think there's some debate on whether we have regulatory clarity or not. I think the EOS settlement
didn't seem very clear to me.
If anything, the waters got muddier in the last month.
I would agree. And the clearest part of the message is, if you have enough money and you're big enough, you can bust through the wall and you're good on the other side. And
isn't that such an uplifting message?
Yeah, isn't that like America? Yeah, opportunity, meritocracy. It's kind of like in the case of Bitcoin, just let it be and it'll be like air, nothing to see here. And that's hard to replicate at this point. In the case of Ethereum, it's more, well, that was a while ago.
Water under the bridge.
Water under the bridge, right. And in the case of EOS, it's really different. It's like, I wasn't there in the room, but like...
They're big and intimidating and we don't want to litigate against them.
And so none of those are great stories for... I want to see a state of the world where crypto assets can move freely so that we can have all the things that I think we're interested in having. And I also want to see a world where it's possible to go from start to finish and create them, because otherwise we're sort of stuck. So I don't feel like there's a clear path. If the clear path today is either do a Reg A, which several of our portfolio companies have done, which in some ways is a path forward, but is also a limited path, or evaporate yourself from the system in the case of like a Grin or something else like that, where it's just like write some code, put it out there.
It's a real paradox at that point then, because it's like, how do you build a system you want to build if you have to decentralize yourself?
Right. I'm not opposed to everybody's going through this process right now of how do you decentralize it. And even within our universe of our portfolio companies, a lot of other companies I talk to, there seems to be a point in the life of your crypto project where you have to start to disaggregate the pieces and think about what happens if the company vanishes or just disappears for one reason or another. And I think that's how it should be eventually, because these things, if they're successful, should just be like air. Bitcoin is like air right now. It's just there. And there are a lot of people behind it, but it just exists. And I think very few other projects are there, but you kind of have to get to that point. I don't know that EOS is air yet, but they have, not even close probably, but they have at least cleared the wall of the SEC.
There are so many angles to this with the regulators. I often get a little bit frustrated that there's not more in the way of concrete asks. If you think about our thesis, there are some pretty concrete asks that I think would really help some of our companies, which would be around definition of a good control location under SEC 15C3-3. Can a broker dealer hold Bitcoin or other digital assets? But I think it depends on what the company that you're advocating for. And so I guess circuitous way of getting to the question, do you think that there is a mutually agreed upon ask yet for some of your companies, or is it still evolving? Do you want the Howey test rewritten, or just give us a guidance on how to decentralize and not be a security?
Yeah, I mean, I think, no, there is not consensus. Everybody's afraid to ask for anything because you don't want to get your head blown off. And so there's a question of whether you should ask for anything. And then it's been pretty unclear about what's sort of possible or what the mindset is. In my mind, it's a gauntlet. You start out as something that looks like a security and you end up as something that looks like not a security. And there's no pathway on how to get there. The SEC guidance from earlier in the year, not super helpful because it's not weighted in any way and it basically makes everything seem like a security. The Reg A Plus kind of gets you halfway in the door, but then there's no sort of way out, no defined way out. And so there have been conversations over the last couple of years about some type of a safe harbor that would allow you to get in market and build and grow, maybe under the purview of sort of securities laws, but some sort of an exemption or a carve out that then gives you at least a clear path to prove something and bust out the other side. But I haven't seen anything along those lines that's been really clearly defined. So I don't know that we have a concrete ask yet.
Yeah, well, that's all right. I think that there's been a lot of evolution over the past few months.
One thing that I always keep coming back to is if you look at securities laws, a lot of them focus on disclosure. Some could say that's why the WeWork IAPO fell apart, because they published their S1 and then all the tech bloggers got their hands on it. And also the analysts, the buy-side analysts got their hands on it. And they realized that the story maybe wasn't as backed up by data as they might have thought it was. But there's no equivalent of an S1 in crypto. I haven't even seen a concrete proposal for one. I mean, do you think there is scope for some sort of crypto native disclosure framework to help inform public market investors around some asset that's coming to market? I mean, if you read the SEC Telegram, not decision, but whatever the letter they sent to Telegram.
Oh, that one wasn't settlement. Right. Yeah. The order or whatever.
Yeah, the word disclosures in there is like 13 times. Because they wrote, I guess, some technical white papers, but nothing really about the nature of the token and the nature of the entity issuing the token and so on. Do you think such a thing could be crafted, or is it kind of a strange thing to ask for?
I think it's precisely the right thing to ask for. And the whole point of the SEC regime is about investor protection. And on the issuer side, it's all about disclosure. Within markets, that's different. Also about disclosure and integrity there. But I think we've spent 100 years defining the disclosure regime for companies, and it's not the same as what you need for an open source crypto asset project. So
we don't even know what the right questions are to ask.
Right. I mean, it's not about what are your operating finances, what is your cash flows. It's not all the things you would ask a company. It's more about what's published in the code. It's more about the supply schedule. It's more about who are the holders, who has commit rights. These things that are much more technical, many of them you can actually get from a lot of projects. I think Messari probably has done the best job of trying to work towards something that looks like crypto native disclosure, but it's still very early.
My belief is that if we eventually settled around some codified framework, or at least made the disclosure environment better as far as token sales go, the SEC would be pretty pleased about that and maybe even willing to work with the industry some more.
Yeah.
I think that holds true also on the market infrastructure side, by the way, around if you look at some of the reasons why the Bitwise ETF was denied, a lot of that having to do with surveillance sharing agreements between the on-ramp exchanges and the fact that there is no SRO. There are these steps that could probably be taken in order to to help all sides.
Yep. I've spent a fair bit of time down at the SEC over the last couple of years, and a lot of what's there is like just the ICO boom of 2017. It just rubbed everybody really wrong. And there were a lot of projects that did things a lot of different ways. Don't want to overgeneralize, but you can understand that the perception of that was, oh, this is just a bunch of fundraising to build stuff, unregistered securities offerings. And then that has, I think, just made it more difficult to have a forward-thinking conversation around, we've got this new type of asset. It is a transactable asset, and it's something that accrues value. It is sort of can be created by someone, but also taken on by others. And here are some ideas why this is beneficial in terms of financial inclusion and access, and as a counterpoint to traditional tech and financial platforms. Like, there's a lot of things about the story that are really good, but when you talk about them under the looming shadow of billions of dollars in ICOs that just many of which seemed on their face to be on the wrong side of the rules, it just makes it a little bit harder to have that conversation. I think we're going to get there probably. And a lot of projects are now, as much as we don't have like perfect clarity, it's becoming clearer what not to do.
Some of that is don't stay in the United States, unfortunately.
Unfortunately, yeah. Start overseas. Don't sell tokens up front. We've seen many flavors of convertible instruments or multi-token models where there's one token that's a security and other tokens that might accrue to that, like a sort of a Zcash style founder's reward, or no one knows exactly what the right answer is. But I think it's pretty obvious that selling tokens in advance for a system that doesn't exist yet, that's a bad thing. And you got to figure out a way to get them out. And we're starting to see Rule 144 type dribble out stuff happening. Or you might argue that the EOS settlement supports the SAFT framework, where you would have an initial offering to private investors that's a security, and then you transition to a token that's not a security. So like, I read that as sort of a positive view.
I read it as a positive for the SAFT, and then I read the Telegram one as a negative for the SAFT. So I don't know what to think.
Yeah, that's right. Because in the Telegram one, they kept saying, well, the firms that bought the initial offering are going to distribute it to the public, and the public deserves a disclosure at that point. I found it incredibly contradictory, actually,
I did too.
Between Telegram and EOS, with EOS being kind of a ringing endorsement of the SAFT
Agreed.
model.
Yeah.
And the endorsement of the idea that the pre-mainnet IOU token is very substantively different
Correct.
from the post-mainnet actual token.
Yep. We're not involved in either project, and so I don't have any inside dope. But I think also part of this had to do with the deadline looming on the Telegram token and the risk. Like, if that deadline wasn't there, it came to market in a different way, then that probably wouldn't have happened that way.
I thought it was interesting that the Telegram holders collectively went to Telegram and said, no, we don't want our money back. Go ahead, fight. We want to launch.
Yep. Those are the investors some of the investors that would be protected by stopping this. But I think there's another one, which is like the public retail investors who would be on the buy side, presumably. But I do think that's good.
So maybe switching gears to a more uplifting topic other than regulatory, we could complain all day about the lack of clarity. So let's talk about smart contract platform category, views of the general state of Ethereum. There's obviously a ton of competition in this market. You've invested in some of the Ethereum competitors. So what's your view on smart contract platforms in general? How does Ethereum look right now versus some of these competitors?
Yeah, I don't know that I have the definitive answer on this, but I'm happy to talk about it. I mean, I think when I look at Ethereum as a platform, I think it expresses a lot of the ideas which we've always thought are really exciting. So the fact that you've got layers upon layers upon layers of code that are interoperating without anyone asking anyone else's permission, and they just work together, like that really does embody the kind of thing that we think is possible here. Sort of completely separate from the money use case, more of like the layers of new internet protocols without any gatekeepers and just raw creativity. Ethereum rocks on raw creativity. There's an amazing community of people trying to invent new things on Ethereum every day. And I think that's awesome. There's a big question of how far does that scale? And I don't know that I'm qualified to really opine on that. And no one really knows exactly whether the ETH 2.0 thing will ever happen, or whether it will work, or whether it will cause problems or not cause problems. There's a question about how strong is the network effect of Ethereum today? I think that's kind of an interesting question. There's a lot of Ethereum connected to a lot of different places, exchanges and wallets. And then you've got this layering of protocols and assets, interconnection of assets, which creates like a clustering and a stickiness. And so there's a question of whether those can get unlocked or unwound, or whether they even have to, whether they're even material in terms of scale, like on a global scale. As far as the EKs,
I like that.
Chris Bernisky wrote the post the last week. Maybe he wasn't the one who invented that term, but it has stuck. We have really just one direct investment in something that could be considered in that category, which is Algorand, based here in Boston. And that comes out of MIT. It's proof of stake, and it's designed to be fast. And today it's very simple in terms of what it can do, but they're building really exciting functionality in terms of being able to create layer 1 tokens and swaps and transfers all at the base level of the protocol. So I'm excited about that because I think it will open up new use cases that Ethereum doesn't support, but it all remains to be seen. Everybody thinks that they've got a faster, better Ethereum today, and there are many of them that have launched and haven't launched. And so there's going to be a reckoning in the next 12 to 24 months of how useful are they really, how much adoption can they get in the enterprise and with developers and with community, what breaks when they launch. I don't know. I think from our point of view, it makes sense to have exposure to that category because of the creativity and like the amount of just interest that it can generate when it's done well, but we don't know.
One of the fascinating things about Ethereum when it was pre-launch was just that Vitalik was on an airplane every single day and having these meetups in tons of cities and just getting people energized around developing on top of Ethereum. And it's pretty clear that, to your point, there's such a vibrant ecosystem there of people building on it. How does one replicate that? Is it just this cult of personality that you have to be on a plane and revving people up to come to meetups? How do you get the developers?
I don't know. I mean, I think that's definitely part of it. I look back at the other dev platforms that have really soaked up developer attention over the past 10 or 15 years that didn't have money as part of them. Ruby on Rails versus Django, or like jQuery versus all the other JavaScript competitors, or iPhone versus Apple is obviously a sort of a different story, or Twilio versus Tropo. I think there's a part of it which is getting on a plane and doing the best events and getting people excited. There's a part of it which is just user experience, which is magical and great for developers. I don't know if you guys were old enough to be around when jQuery was battling all the other JavaScript frameworks, but all the other JavaScript frameworks were exactly the same. And then jQuery invented just a new syntax for writing JavaScript that was just faster and more expressive and more just lovely. And it just ran the table. And I caveat all that with the money part really changes things because people get really much more invested here and are less likely to sort of switch. But I do really believe that experience matters for developers, and giving people tools that they really like working with, tutorials, just sort of like all of the sugar around it that makes it fun. And ETH has done probably the best job of that of anybody so far. I guess what I was trying to say before about all the new platforms is we didn't really know what ETH was going to be for when it came out. Turns out it was for ICOs.
And later on
and
for
DeFi.
DeFi.
Right. Yeah. But that, again, also took 2 years after,
And no one predicted that, really.
Exactly.
Yeah.
And so I think it's a little early to say what will and won't be possible on the EKs, because maybe you can just do fundamentally different things with them because of the scaling properties.
So speaking of the effect of the inherent moneyness of these things on developers, one thing I noticed was that you look at the governance models of crypto assets and you think that there are definitely parallels to the way open source projects are governed, but also the stakes tend to be a lot higher because there's financial consequences. And so I don't think it's exactly maps over to open source governance. It's harder to have that really open, friendly, collaborative feeling if tweaking something in the protocol can financially reward some economically interested entity and punish another one. So, and I think the purest expression of this is when you have a developer fund, which comes from the rewards, like Zcash, for instance. Do you think that that is, so there's a school of thought which says it's actually good that we can have that because you can pay developers directly and you can pay for public goods in a way that doesn't work with the community-based funding, for instance. There's another school of thought which says, well, it introduces the risk of corruption or lobbying as everybody fights for their share of the pie. So I don't know, where do you fall on that debate? is it worth the ability to finance public goods in a protocol context if the cost of that is potentially capture?
Right. What's funny is that you could also argue that the public goods have not been sufficiently funded even in this model. And so obviously holding a lot of the base currency and selling some of it off over time is one way, but that's not even necessarily sustainable depending on which way the markets go. You could just be burning your pile down. And so I don't even know that it's safe to say that core development is sustainably funded in this model. But for sure, it makes switching costs harder because you feel like once you have an economic position in something, to walk away from it is to just walk away from that economic position. It introduces some funny dynamics when new people enter a space, whether they're developers or investors or whatever. It's like, do you just pile on to this thing that other people already got a way better deal than you on and try to ride it up? Or do you try and find something else that's fresh ground? So that's a challenging dynamic. We're probably at the moment where there's still so many people who haven't come in that you could make both sides of that argument. One, that like if everybody who hasn't come in comes into any one asset, there's still plenty of room to grow. On the other hand, there's probably room for other projects to try and soak up all the new energy and say, hey, get on the ground floor with me instead. So it could kind of go either way.
Because nobody wants to enrich someone else by being the latecomer to their protocol.
Right.
Is there a counter to that, though? Because I think some of these projects just introduce such a religious zeal to them. Think about Bitcoin. So you have people that are new developers coming into Chain Code Labs all the time. John Newberry is a pretty prominent Bitcoin developer, and I think 18 months ago, he was not. I mean, he was not developing on Bitcoin. So presumably he doesn't have the stash that the Blockstream guys have, but he's ideologically motivated to work on the project. What do you think about that? I mean, I'm kind of looking at you because you're contradicting.
So you're saying that if you have a very strong, distinguished set of values, then that can get people over the trepidation or the unwillingness to be a latecomer to some crypto protocol?
Yeah, and I'm saying that developers aren't always motivated by money. And so they want to work on something that has meaning. And so just because they're going to have less of the crypto asset than the others, it doesn't matter.
Yeah, I don't even really buy the story that Bitcoin devs work on Bitcoin because they have a lot of Bitcoin. I think that's kind of a facile characterization. I know plenty of Bitcoin devs that were just students when they started working on Bitcoin, and so they never really got their hands on a lot, but they do it because they just believe. Same with Ethereum, actually.
For sure. Yeah.
I think that's probably what differentiates those two projects in particular from a lot of the other ones.
Yep.
And they're also quite lucky that there is some patronage happening, although I don't think it's the best model in the world. I mean, it's not something that can be planned for, but the fact that there are, for instance, 6 or 7 probably different organizations that will pay for, at least in Bitcoin, pay for developers to work on whatever they want, whether it's Square Crypto or Chaincode or Blockstream or the MIT DCI just up the road. I think that it's definitely not the best because it's kind of hard to coordinate big build outs, but at least it gives a few elite developers the freedom to work on the protocol. And potentially lacking that pool of capital, which is protocol funded, reduces the number of mercenary devs, for instance.
I think a lot of it also comes back to the looming question of, is this a zero-sum environment or a positive-sum environment? And I think a lot of the conversations about crypto as money lead back to more of a zero-sum mindset, as opposed to crypto as an architecture lead to more of a positive-sum mindset. We could spend 2 hours probably just talking about that. It does seem to me that I would hope that there's room for many different projects to do many different things that can have healthy, vibrant communities that are not necessarily all vying to be money.
Yeah, something I find to be healthy is actually this new trend of stripping tokens out of certain crypto projects, like Compound, for instance. People use Compound, but you don't have to use a token to use it. So paradoxically, removing the token in certain cases makes people more willing almost to use something because they don't get the feeling that they're enriching the token holders in that case by using the application. It's kind of the converse, I guess, of some of the theses that we've had in prior years.
When we started investing in crypto related things, this was sort of after we got interested in Bitcoin, after we invested in Coinbase, but prior to ETH and tokenization, we did a whole round of investments that were just non-tokenized open protocol development. And this was Protocol Labs and IPFS before there was Filecoin. It was Media Chain, which I don't know if you guys know this one, but this is Jesse and Dennis who went on to Andreessen. They sold Media Chain to Spotify, but it was like a open data architecture for metadata and attribution, digital assets that was in the spirit of open protocols, but without a token. And Blockstack actually started the same way. Numerai also started the same way. So there was like a whole wave of innovation here that was sort of pre-token mania. And then we've kind of gone through token mania. And I think what you're seeing is the other side of that, which is there's going to be a lot of healthy development in more open protocols that are work in and around tokens, but don't have to have their own necessarily.
I'm certainly looking forward to the phase that we consolidate around maybe 2 or 3 chains, and there's less of this competition to be the winning protocol and more of an emphasis on, well, let's just build interoperable tooling here to make these things actually really useful.
I mean, what's your guys' take on the Ethereum Killers? You don't have exposure to any of the smart contract platforms. I
think it goes back to what we were talking about earlier around the theory of why a token on one of these networks ought to be valuable in and of itself. Yep. So we like to talk about people do not hoard oil in their backyard. They fill up their car with gas and they put a little bit of oil in it and they use it. And the theory really would be that unless these things are treated like money and hoarded, then the velocity of the token on the network ought to be quite high. And with a high velocity, then it would lead you to believe that there's a world where these things work, but just don't retain a lot of value at the protocol layer. And so there would be some value there, no doubt, but it would be a lot thinner than maybe people would think, and certainly a lot thinner than money.
And I think a lot of protocols right now are trying to solve the velocity problem and find ways to make the token required.
Yeah, I would say ETH stumbled on this with DeFi, where there's so many use cases that require collateralization. I think that was a roundabout way of getting to these velocity sinks, which is actually probably quite promising for ETH.
And I guess I think it goes back to this original idea that it's a little bit like money and it's a little bit like stock and it's a little bit like something else. And so we're seeing more tokens that are staking tokens and that have to do with identity and have to do with not necessarily just a financial collateral, but some other kind of personal collateral or a right to work or something. And so, I don't know, someone will come up with designs for tokens where there's real reasons to park them in places because it says something or because it accomplishes some other thing. And some tokens may look like a license more than money or something else.
Definitely. I think there's analogies. And even if you do believe that these things are just money, there's more than one money out there.
True.
But we'll probably have fewer than 200 like we do with sovereign currencies.
I think that's right.
Yeah. My answer to your question is probably a little different. I mean, I don't really disagree with what Matt said, but I see cryptocurrencies as these institutions that live outside of the purview of the state, and they give you certain rights and certain assurances, and they have varying degrees of credibility as institutions. And sometimes the developers will do arbitrary and capricious things and alter the nature of the property rights that have been established or change something unexpectedly. I think that sort of impairs the credibility of the institution. For instance, so if Bitcoin were to one day change the supply cap, that would really undermine the confidence of the whole thing, probably, because that was set out as one of the, the core founding values, the constitutional values. And so these things definitely need to malleate to some degree to change and evolve. But if they do that in a way that violates the social contract, for instance, I really do see a huge number of parallels to these things as polities, political institutions. So I think by far the biggest challenge for any of these upstart chains is to acquire the credibility from a set of users and to convince potential users that the developers won't engage in rent seeking and won't change things arbitrarily. And that takes a really long time to get. Bitcoin, people are still like, well, how is Bitcoin going to do in this situation or under this circumstance? Ethereum, I think, had a really significant setback, to be frank, with the way they responded to the DAO by making a change in the ledger, which might have even benefited some of the devs that didn't want the DAO to be a total zero. And so they've spent a lot of the time since recovering from that and saying, well, actually, we're not going to do that kind of thing again. I think that's actually quite important.
An open question is like, what's the process? So sort of on one end of the spectrum, you have Bitcoin, where it's really meant not to change very much at all. And then the other end, you have a central bank or Facebook or Google who can do whatever the fuck they want, basically. Those are sort of the things that we're used to having right now. Either a completely controlled system with no governance or a really rock hard type of system. And it seems like a lot of the projects are kind of starting to play in the middle. Is it possible to have governance that gives you more malleability than you have with Bitcoin without becoming arbitrary or undermining trust? And I can't say that anybody has figured this out yet, but I do think that's where a lot of the discussion is.
That's the question for many of these projects. They'll have to answer that for sure.
And it also has to do with back to the regulatory question. I mean, I kind of think the SEC is involved as long as there's control.
Yeah. And sometimes the control is veiled. Angela Walsh, who's this legal scholar, looks at crypto. She calls it the veil of decentralization. It's sometimes used in this industry as a way to ward off regulators by teams that might actually be in control behind the scenes and that are saying, oh, actually, nobody's in control, the community's in control. But in practice, there is specific control and there are levers that can be pulled by the devs.
And that gets back to the question from before about what does disclosure look like? What does it take to uncover those controls? And then if we're thinking about like a pathway through the gauntlet, what are the right protections that need to be in place while those controls exist that maybe aren't the same as filing an S1, and registering with the SEC?
I think they emerge in times of crisis. You have like peacetime governance in crypto assets and you have wartime governance. So in peacetime, you can, in some cases, like really maintain this facade of being totally decentralized because everything's going fine. Dev calls go great because there's nothing substantive to discuss. And then when there's a crisis, the sort of elites that might actually be in control might actually start to manifest their power because the decisions need to be made. And so that's when you get hard forks. It's like, oh, I didn't know the developers could unilaterally hard fork or whatever. Like there was this chain Bitcoin private a while back, which is basically defunct now. And there was some hidden inflation. So there was a crisis. And the developers hard forked out a whole bunch of the coins. So they just evaporated a portion of the supply. So these things kind of reveal themselves when you have these really challenging critical times. So that's why it's actually really hard to evaluate where the control points are most of the time, crypto assets. So I don't know. I don't think the regulators are necessarily that well equipped to evaluate them either.
Well, I think if you look at the history of crises in general, regulation usually follows those crises. So it's no surprise that the 33 and 34 Act, which are the two most prominent acts for securities laws, are right after the Great Depression. So
maybe we'll get the 2020 Act to regulate securities after the great Bitcoin crisis of 2020.
We might. So, Nick, we're coming to the end here. So some closing questions. If you had to guess, what would be the first kind of breakout application or category that real people start to use crypto assets beyond just holding them as speculation?
Real people. So you're saying...
like my parents, what are they going to interact with? Hundreds of millions of people. What will they use?
Well, there's a few possibilities. One is that it's some sort of, that it ends up in their mutual fund somehow. And you guys are in a better position than I am to evaluate how realistic that is. But I think that's probably the most realistic path. And I think you're saying outside of that.
No, but that's a really good one. I mean, we think about the application layer and we actually have that as an application. And that to us is the first application that is happening right now. Now, granted, it's not in a mutual fund yet, but we will have 40 Act products. So I actually accept that as an answer.
It's not the most exciting application in the world.
But it's probably the most. We have a framework that we've drawn out, which is sort of money crypto meets tech crypto. And then you kind of break out all the functions that need to exist to satisfy the use cases there. And it feels to me like it's left to right, money crypto to tech crypto. And so I said at the beginning, like we came at this more through the tech crypto lens and sort of Web3 and digital identity and all the stuff. And I actually think that stuff's like pretty far down the line towards the right. And it's still the stuff that fundamentally gets me really excited, which is no more passwords, browsers where my identity and my payments are just built in. Everything is open and interconnected. The web it's like walking through magic on the web. That's where I think we're heading, but that's not the first thing that's going to happen.
That's a good answer. And I agree. A lot of people will hop to a game or something like that. And I think maybe that's the next wave after this. But I certainly think that putting these things into investment vehicles is an application.
For sure. We're not working on that really at all, and I'm glad you are. We have, by way of Coinbase, and to the extent that infrastructure like that is going to be part of it, but like sort of ETFs and other things like that has not been something we've been working on directly.
I think people who are aspiring entrepreneurs that come from a financial services background that are looking at this industry ought to read the Bitwise ETF denial from the SEC, because it basically has a playbook of the types of businesses that need to be built in order for that to be possible. And so it talks about qualified custody is becoming a lot less of a problem than it was in the Winklevoss era, but regulated exchanges, spot market surveillance sharing agreements, things like that. So we're getting there.
There's also another path where consumers aren't the first direct users of crypto, and it's developers. And so if the sort of Filecoins and Heliums of the world, if the sort of functional compute layer, decentralized compute, if it really takes off, which it hasn't yet, obviously, but like you could imagine functions of those filling in underneath the dev stack and where people touch crypto without using it. And it removes some of the money-like requirements of it, and it would start to feel more like the other protocols that your computer uses or your phone uses every day as you walk around the world. So I think that's also possible.
So if you could fix or change one thing in this ecosystem, what would it be?
Obviously, the regulatory stuff is hard. And if you could fix all the things we talked about, it would make everything easier. That's not realistic. And I think part of the deal is we just have to kind of work through it. The other one we were talking about earlier, which is the sort of zero-sum nature of the ecosystem. I don't love that, but that may just be the way it is.
You're talking about just the tribalism and
the
the,
sort of
like the
tribalism.
Rage quitting and the...
Like crabs in a bucket, right?
That is exactly the flip side of people having an economic stake. So you can't celebrate having an economic stake in things and also be upset when people become tribal about where their economic stake is. Like those are two sides of the same coin.
Yeah,
so
it gets pretty ugly out there.
That's not a great answer. If you could wave a magic wand, what would it do?
I think for me, it would be on the regulatory side, mostly with the SEC around just clarity on whether or not a broker dealer can hold these things and what does a possession and control of a digital asset look like. And that's more than just Bitcoin. So that could be a security token, anything really. So I think we need some rules of the road. I also think that there are some big companies that are looking to do things that just won't do them until that regulatory clarity is there. And the state of New York's not helping anyone with any of that. I mean, there are large companies looking at the bit license and saying, no thanks. Like, we'll take a look at that in 5 years once you realize that it's unworkable.
One very specific magic wand on the regulatory side would just be tax treatment and sort of de minimis exemptions from capital gains, just like you have with currencies. None of this works if you have to treat these things like property from a tax perspective. It just doesn't work.
It's shocking that the IRS spent so much time on it and didn't give us that in the end.
How much time have they really spent on it? They took a lot of time. I don't know how much time they spent.
They learned what a fork is. If I had to pick something, it would be for exchanges to conduct client-facing proof of reserves to prove to their depositors that they have the assets that they claim to have. I think that would ward off the Quadrigas of the world.
That's very specific, and I think that
is my specific ask. If you're listening and you're an exchange, please do that.
Or if you're a startup looking to do it.
That's true. It technically is actually not simple.
Well, it gets back to your point earlier about trust. The whole sector has a trust problem. The regulators don't trust it. Projects don't trust each other within a project. The different stakeholders don't trust each other. Nobody trusts the exchanges. It's scary out there. That's not great.
And my point is that if we just surrender these assets into the same custodial model as the existing financial system, we've not achieved anything that interesting. The good thing about crypto assets is that you can prove to a third party that you own them. That's one of the good things. So let's use the transparency to minimize the trust dependence on exchanges.
So what are you most excited about over the next couple of years in this industry?
Well, the easy answer there is a lot of teams have been working on a lot of stuff for the last couple of years, and a lot of that's going to launch in the next 12 to 24 months. So say what you might about the ICO boom, like it funded a lot of dev teams who are building a lot of stuff. A lot of the stuff that they're building is complicated and not easy to design and build and launch. And a lot of stuff is going to launch in the next year to two. So that's one. The other one that I'm excited about is just more crypto built into more things. So the HTC phones have launched. The Brave browser has much better wallet support now than it did a little while ago. The infrastructure is starting to step up a little bit that's going to make more things possible. All that stuff is really slow. So there've just been a bunch of really slow things brewing for a while, and I think they're going to start to bear fruit soon.
So Nick, where can people follow you and Union Square Ventures?
Sure. I'm just at Nick Grossman on Twitter, and I blog occasionally at nickgrossman.is, USV at USV, and USV.com.
Thanks so much for joining. This has been a lot of fun.
Thank you.
This has been another episode of On the Brink with Castle Island Ventures. To learn more or to subscribe to our newsletter, please visit castleisland.vc. And a big thank you to all of our listeners, except those of you who believe in the underlying blockchain technology, but not cryptocurrency. You know who you are.